So one sector we stayed well clear of, even though there's, I think, a lot of debate internally whether we should do it or not, were these types of B2B marketplaces. So companies like Maxab, for example, Sari, Retailo, Bazaar, Shari. There was a ton of these, and I do think there's an opportunity there, and I think we at some point we may invest in something like that, but it has to be not driven by just we're able to kind of scale GMV super fast, but we're going to figure out how to expand margin later through ancillary services. I feel like that's always like an intellectually slightly dishonest way of approaching it, because it's very hard to tag on ancillary services that generate margin. It's intellectually possible, you can conceptualize it, but then actually in reality it's very hard to do that. So we ended up staying very clear of those types of businesses, because the value proposition was weak. It was really focused on just growth through subsidy, which we couldn't wrap our heads around it at all.
Hi everyone, welcome to the Postmoney Show, a new podcast where we speak to founders, investors, and other stakeholders of startup ecosystems across Middle East, North Africa, Turkey, and Pakistan. Today, in this episode, we've got Khaled Talhouni with us, who's the founding partner of Nuwa Capital, a Riyadh and Dubai-based VC firm that invests in startups all across the region. Khalid has been investing in startups across the region for a little over 10 years and has made some pretty big, significant investments in the region with his current firm that he founded a little over 3 years ago, if I remember correctly, perhaps in 2020.
Correct.
He,
Yeah.
they have made over 15 investments, some of which have not been announced yet. So we'll talk to Khalid, learn a little bit about his background, and see how the ecosystem has evolved and what does he think of the current landscape. Thank you so much, Khalid, for joining us, taking the time today. It's a pleasure to have you here.
Thank you, Zubair. It's always great to see you. Just an update. I think we've done 30 investments from this fund so
Oh
far,
wow. Okay.
and
Okay. So I
and
don't
I
think
have
many
been
of them are
invest.
announced yet.
No, no. I think a lot of our companies. I mean, we're keen to announce, but I think our founders are much more circumspect when it comes to announcing these days. So there's a lot more reticence to kind of make a big splash, which I think is a healthy thing. But yeah, so that's thank you for having me again. I really appreciate the time.
Yeah, so a lot has changed over the last 12 months. I think one of those things is that, founders don't really care much about going and announcing their rounds as they would, maybe a year or two ago. Because back then, founders would plan almost everything around it, including their hiring, that they'd go announce the round and then, plan their recruitment around it and sometimes even product launches. But a lot has changed. And I think given everything that's going on, it makes a lot of sense. Maybe you keep a low profile, try to build your products, and then see whenever is the right time to perhaps go and make those announcements. Not just whenever you raise the round. But let's just start with
Yeah,
your background. It has been over 10 years since you first started investing. You started as an
I'm
associate, if I remember correctly, with 2454. I mean, that's where your VC journey started.
yeah. I mean, not to bore you actually, but it's been over 16 years.
Wow.
So
Okay.
when I got out of university, I kind of I studied in the US, and then I didn't know what I want to do next with my life. So I ended up here in Dubai, and trying to kind of figure out what's next. I think the typical career path for me would have been to become an investment banker and then maybe go to law school. That was my original plan, at least. And then when I got to Dubai, I joined, doesn't exist anymore, but it was a private equity group called Dubai International Capital. And they wanted to launch the region's first seed fund, along with an angel network to encourage high net worth individuals to invest in entrepreneurial companies. So that's where I started really. So I put that helped put that fund together. We launched. We created the network. We invested in some early companies. It wasn't only tech focused, so it was a bit more kind of broad. But eventually, there was the great financial crisis, and that the whole private equity firm wound down. I went from there to another firm called, but by then I was really interested in founders and startups and investing in early stage companies. So from there, I went to what later became Silicon Badia. This is about 2008. And so we also started investing in early stage companies. And then I got to 2454, where I ran the early stage. I started as an associate, but then I eventually became the head of investing. We had $100 million media tech fund. I did a lot of early stage investing. Most notably, they're invested in Jawakir, which is still today my best performing company. I think like for like, we did 100x cash on cash when we exited, but it took a long time
Wow.
to exit. But
Wow.
we also did other things like we did some IP based investing in gaming companies and gaming generally, which did very well. So we invested in like a Ubisoft property and stuff like that. And yeah, and then and then from there I went on to Wamda Capital, where I helped set that up. Probably the region's first kind of and largest at the time in 2013, 2014, the region's first like institutionalized VC platform. Um, Ended up investing in some great companies out of that. The likes of Kareem, Insider, Mom's World, some really great kind of marquee assets. That fund's done, remarkably well, very well. And then in 2020, as you mentioned, I spun out with my partners Sarah and Stephanie, and then eventually Nitin, all kind of former Wamda, to set up Nuwa Capital. And then we subsequently raised our first $100 million fund, and it's been, yeah, quite the journey.
Yeah, yeah, yeah. I mean, obviously, it has been a long time, and you're one of the veterans of the VC ecosystem in the region. The first firm that you helped set up I mean, after you graduated, were there any notable investments that you still remember? I mean, companies that have managed to stay alive or turned into uh, decent exits or
Not really, I'm sad to say. So we invested in like an ostrich farm in
Okay.
Jordan, which I don't think led anywhere. We
So there were no
invested in
tech
a
investments.
No, no, there were some. So we invested in a company in Lebanon, which I think did reasonably okay in the end, which is called PinPay,
Okay.
which basically enabled you to um, do mobile credit top-ups from grocery stores and places like that in
I
Lebanon.
see. I
That did
see.
all right. I think that was probably the most successful out of that portfolio. The most interesting one we invested in is a company called Hayati Healthcare. Basically, it was a early fintech. This is 2007, that basically did allowed you to get on the spot financing for elective medical procedures not covered by insurance. So think of like cosmetics, dermatology, even obstetrics, stuff like that. That company didn't survive because of the crisis, I think, but it was really ahead of its time, a precursor of its time. The founders were, two really great entrepreneurs called Tariq Titi and Michael Mutley. I have no doubt that if that company was founded like 3, 4 years ago, it would be like one of the major kind of players in the region. But timing is everything, as they say.
Yeah, 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 absolutely, absolutely. So you spent quite a lot of time at Wamda as well, where, as you mentioned, you made investment in some of the biggest companies to come out of the region, Kareem being one of them. Talk a little bit about that. What kind of companies you were looking to invest in? How did you pick these investments? And how then that led to the founding of Nuwa Capital? Why did you think that you want to start, a firm and essentially invest in startups all across the region, plus some parts of Africa as well? These are two different questions, so if you
Yeah,
can answer them one by one.
Yeah. So the genesis of Wamda was that, as you know, like Fadi Ghandour, who's the founder owner of the Wamda platform, was a really prolific angel investor. Um, at that time, he was an early investor in Maktoob.com, which exited and spun out Souq, as long as many, many others. So he's a huge believer in entrepreneurs and backing founders and really kind of, pushing that forward. Um, Basically, like fate had it come together where, he was, there are different potential investors, specifically the IFC, that wanted to create like one of the first like VC platforms in the region and back that. And so I'd known Fadi a couple of years, and so we sort of kind of put that together. And the idea behind Wamda was, how do we take, what was already built, before I was there, like in the Wamda platform around supporting founders, and turn that into an investing platform. So historically, Wamda had done mostly entrepreneurship support, capacity building, that kind of stuff. And how do you kind of parlay that into a investment platform, really the first and largest of its kind in the region at that time. And so we kind of put together the theory for the fund, or the hypothesis, the thesis, and we kind of pushed it forward. At the time, I mean, I like to situate that within a specific context. So if you think about that vintage, 2013 to 2015, I like to think about the companies that emerged from then within cohorts. So you have certain types of companies that emerged between 2013 into 2017, that 4 year period. And so that's when really, I like to say, the region started to grow up. So basically, I hate to say it, but like my early career was really like treading water. Was I was learning how these things were happening, but there wasn't that much to invest in really. Principally because there weren't that many users. The penetration of the internet was quite low, or at least high speed internet was relatively low. But I think you started to see the dividends of mobile first, high speed penetration emerge during that time. And then suddenly the internet population like skyrocketed. And so all of these people coming online across the Middle East and Africa and Turkey, they wanted, you know, digital services of a different, of a multitude of types. So whether that's commerce, whether that's kind of financial services, I mean, you name it, people started to interact online. And so the timing was excellent. So you started that kind of process of maturing in the region. It's still and remains to this day quite nascent, even relative to other emerging markets like Southeast Asia and Latin America. So I think we lag behind the rest of those markets by anywhere between 6 to 8 years. It started maturing, so you start to have like companies emerge that could be of scale. Like we said, like within our portfolio, the likes of Kareem, Mom's World, those were kind of large-ish businesses that had real kind of ability to scale across the region and have like hundreds of thousands of users. You also saw a deepening of talent in other markets like Turkey, where you started to have the emergence of SaaS platforms that were could compete on a global scale. So that's how we invested in a company called Insider, which is a marketing SaaS business, SaaS/AI now. But So you started to have a maturation of the type of talent and the type of companies emerging at that time. We didn't over specialize, and even today within Nuwa, I think we continue forward not to over specialize, because we still think the depth of opportunity is still reasonably shallow, where over specialization might lead to kind of a bit of adverse selection. So you want to be able to make sure that you can still invest in whatever sectors are emerging, because there isn't that much. There is, compared to like 6 years ago, it's like a sea change, but still, you don't want to over specialize because you don't want to miss the next large opportunities that are emerging. That might change over the next 5, 10 years as the market deepens. But right now, I think like, we were quite agnostic, and also Wamda was, and Nuwa is the same. We want to kind of invest behind opportunities as they emerge.
Right. And what's the
Um,
thesis of? So sure, please go ahead.
Yeah, and then I think, as I mentioned, like myself, Sarah, and Stephanie, and then eventually Nitin, we spun out of Wamda to build Nuwa. We wanted to kind of build something different, something we talked about before, you and I, a few times.
Yeah.
So we wanted kind of, it was time for us to kind of like set up our own thing. Timing was, I don't know if it was great or awful, but it was just the beginning of COVID. Well, before COVID happened, but it turned out to be quite fortunate. So we've had a good ride so far. Um, yeah, so that's the background.
Right. And how did you decide on a few things? Like when you're starting a firm and you had been doing Wamda for quite some time and your partners as well, Stephanie, Sarah, and later, Nitin joined. Nitin, I think, between Wamda and Nuwa worked at different firms leading their
Yes,
e-commerce
yeah,
efforts. So he also later
correct.
joined you. But how did you decide on, for example, the fund size, the markets you want to invest in, the opportunity you want to go after? And then there was something very specific that you wanted to build in Nuva, which was, a network of founders who could help your found portfolio companies. I don't remember the details, but
Yeah,
you wanted to emphasize on
yeah.
you were very focused on that from day one. So how did you structure the entire fund and the thesis around it? Talk a little bit on that, please.
So yeah, so I think we wanted to do a few things. So around the kind of wider Noah platform, and that's evolved since then. So the first thing was we felt that founders in our part of the world needed a lot more support than elsewhere. So if you benchmark against like Andreessen Horowitz in the US, Andreessen, for example, was able to scale very quickly and, in some ways compete. Oh, in many ways, they're kind of a market leader, compete with the old aristocracy of Silicon Valley, the likes of Sequoia, etc., by having this kind of operating partner model, where instead of hiring a bunch of people who lead investments, which they did, they focused more on building an operating model bench that are a lot of people who are subject matter experts in areas that are very useful to founders, so technology, product, etc., recruitment, finance, legal, etc. So we wanted to kind of build on that model. Their theory was that means that the best founders want to come work with them because they can get some mileage out of their talent. Um, for us, we also thought that would be useful, but also we thought that our founders will need more help because we're in a much more complicated environment. The depth of talent is not as deep as in the US. Um, but also we can help lead to kind of better outcomes. So the first thing we did was we created this network of entrepreneurs and subject matter experts that we make available for our companies. And Nitin leads that function, so he makes he himself is an operator, so he actually works very deeply with those companies. As we've kind of had a few years of experience of working in this model, what we've found out that it's much more useful to have people operating partners full time rather than part time. And now, as we scale the platform, we're adding to that team rather than have people on a part time basis. As we grow our AUM and the amount of fees we can generate, we're principally hiring for that. So that's the first thing. The second thing was we found that we wanted to figure out how we unlock the Saudi opportunity. That is the largest consumer market in the region. And so, a principal area of focus for us is figuring out how do we crack Saudi for our companies. And we do that in two ways. A, we have presence on the ground there. So, we have part of the team is on the ground, like working out of there. Number two, we partnered with a Saudi institution in our GP, that's an investor in our holdco, who helps add value to our underlying portfolio companies. That's Al Faisaliya Group, which is an old, 60-year-old, 70-year-old institutionalized conglomerate with a strong private equity arm. So they understand, our business very well. They anchor our funds, and they're also a shareholder in our management company, in our holding company, in the firm itself. And then we also have figured out that we can engage with a lot of our LPs, particularly in Saudi, around verticals they're involved in to help support our companies. So they work with our companies around unlocking new products and new opportunities or investing in them. And we think that's a really interesting way to kind of grow the platform. And then lastly, something we're building towards, which we're not really announcing yet, but we're starting to kind of build towards, is this kind of multi-product, multi-strategy firm where we have an early stage fund, which is our first fund, our $100 million fund. We're looking to develop in partnership with another asset manager where they would manage it and we would support and we would advise basically a venture debt and private credit fund. And then we're also looking at a late stage fund, like a growth fund. But the idea is how do we build vehicles that solve for the capital needs of founders across the region in specific ways? So a seed fund is very different to a late stage fund. So we want to make sure we have the tools available to be able to help founders cradle to grave throughout their life cycle. And that's kind of part of how we want to, build the platform long term. We're still early days, we're still figuring it out, but I think that's something that we want to kind of build towards in the long run.
Right. So I mean, there's obviously a lot going on, but in terms of the seed fund that you started with and that you currently have, I mean, you're obviously working towards other things as well. But
Yeah.
the seed fund, tell me a little bit about, what kind of companies it invests in, what are the check sizes, how do you, you know, go for the founders that you want to invest in? What do you look for in them, and general thesis of the firm.
Yeah, so it started out actually, if you read our initial documents, it started out as a Series A fund. But remember, we started raising for this in 2020. And then, something interesting happened. As we got to first close of the fund in 2021, and we started thinking about deploying in the middle of that year, if you cast your mind back to that time, it was a crazy, crazy time. Like the, valuations were through the roof, round sizes were exploding. Um, Rounds were closing within weeks, or not weeks, sorry, within days. So, you get a call on a Thursday, you have to sign the document by Friday, otherwise Monday it's done. You lose your allocation. And it was a very strange time. I mean, I've been doing this a long time and I'd never seen anything like this before. And I wasn't really kind of accustomed to it. But then we spent some time thinking about, the if this what does this all mean for our portfolio construction? And can we really be a Series A fund with a $100 million fund size, given that the Series A was now like a 10 million, $15 million round, right? At valuations of 80 to 100, 120 million, stuff like that. Even seed rounds were being done at 30, 40, 25, stuff like that. So we felt that something was amiss. So we did a couple of things. We shifted the entire strategy of the fund early to do seed only, because we felt that you could end up in a situation where you are invested in the right company, so you've picked the right portfolio. But if the market turns, the valuations are all wrong. So you've overpaid and you can't generate a fund-wide return. So I'll give you an example. Um, like if you enter at 100 and 120 million dollars, which is a very reasonable valuation, but the company, doubles, triples in size, but the multiple compresses by, half, then you've not really moved the needle at all at exit, and you may end up in a great company. You've done everything right, you've exited, but then you've made no return for your shareholders besides making the capital back, which doesn't work in our kind of fund model. So we decided we'd rather take the early stage risk, the stage risk, rather than take the what we call like systemic risk, meaning you do everything right, but then the market shifts on you, and then you run out of road. So that's why we shifted the whole fund early. So that's the kind of first thing we did. The second thing we did is we really slowed down deployment. So rather than speed up as the world was speeding up, we slowed down. And the reason for that is because we felt that this was not sustainable. The market must turn. And even if we missed some stuff, that's fine. We'd rather have the dry powder, which we do today, or the capital available to deploy in a market that's more favorable to the capital rather than against capital, so more favorable to the investors. So that's kind of what we did. It's too early to say if that bet paid off, but at least we're not on the wrong side of many, many kind of investments. We're on the right side of many trades. So I think we feel really, really good about that. And that's kind of an important lesson, I think, that we took from this period. And I think you're also asking like how we think what the thesis is for the fund overall. So sector wise, again, like I was mentioning earlier, we're quite agnostic. we do have some areas of focus. So we think there's a huge untapped opportunity in building local brands for the region overall. So we think that's an untapped market, whether that's in fashion or, furniture or eyewear, across these different sectors. Private label, omni-channel retail, we think is a huge untapped opportunity. Not the sexiest thing. I think people don't really think about this segment, but I think it's a big untapped segment. You think about large brands that have emerged, like the giving movement, came out of nowhere, has a lot of scale. And the reason for that is, companies are, consumers are looking for something that identifies with them, that speaks to their respective price point to quality trade-off ratio, and that are digitally native, that are kind of online and offline at the same time. From our current portfolio, we have two companies like that we're really proud of, like Iowa and HomeSmart, that are within that kind of space that we invested in early. The other big area for us is food tech, evolution of food. So we think like food is a F&B generally is undergoing a massive transformation the same way retail did a few years ago. And that includes everything from actual brand building in food to SaaS models to kind of like user experience, like across the board. I think it's an interesting segment. Obviously, fintech is a big area for us. If I were to kind of capture how we think about investing in fintech, generally it's democratizing or allowing or enabling access to financial services to both users and to both consumers and to firms, SMEs, where really traditional financial services have not, done that in the region for a variety of structural reasons. Healthcare is another big area for us, so we're kind of quite active in the space. So I would say, and prop tech, so real estate related ventures. So that those are our kind of general areas, but like I said, it's quite broad. The way we like to think is we want to develop a thesis around the segment. We go deep into that. We decide whether we want to invest or not, and go from there. Because this is a seed fund, you know, we really focus on the founders and the founding team. We will back companies with not fully fledged concepts as long as we really like the founders, the founding team, and people around it. We think will be able to kind of develop the proposition and pivot and grow and develop and evolve as time goes on. So that's kind of like a mainstay focus for the seed fund is really are these the right people we're backing? Do we really like the people who are behind? Um, so that's kind of the second part beyond the kind of segments that I mentioned. Yeah, founders is a really important part. And then three, a key focus for us is regional. So we really want to invest in companies that have a wide regional footprint rather than a specific local footprint. It's a really important factor for us in determining what we'll invest in. There are some exceptions. In Saudi, you can invest in companies that can be Saudi only, but generally we want companies that are region wide or or at least aggregate three or four key markets. The other one that we're really focused on is SaaS in Turkey that goes global. So that's another big area for us. It's a bit separate to what we traditionally do, but we had some success with that in our previous lives, and we think there's a big area of focus that's also slightly untapped that we want to kind of invest behind.
There's a lot to unpack here. Now you mentioned that after starting the firm with a focus on Series A, I mean that's what you had thought that you would do. Then you moved towards seed
Yeah.
round. But if I remember correctly, some of your first investments were in the companies that Wamda had previously invested in, or you had some sort of relationship with. I think Iowa
Yes.
and a couple of others were,
Iowa was one.
right. So
Yeah.
you made a few Series A investments or Series A plus investments, and then you moved to seed round. Did I get this right, or the
Yeah. Yeah.
investment?
Yeah. Correct. Like Iowa was a Series A round, but I think it was early enough pre um, the kind of hype and valuations where the timing was good. So we came in at what we thought was and I think at the time the founders also thought was a fair valuation, good valuation. Um, and we had known those guys since the very beginning, and they're kind of really remarkable, set of founders. And we were able to kind of like scale that and kind of take it to the next level based on our prior relationship at Wamda. So
Right.
um, So yeah, so that, and then we haven't done much overlap with Wamda since, because those companies got larger. The
Right.
successful ones got larger, too large for us anyway.
Right, right. And when you said that, even when you were trying to invest in seed round, you were very strict about, discipline in terms of valuations. You wouldn't invest in companies that you at the time thought were overvalued or were asking for valuations that were unrealistic. So what was sort of the range that you were trying to invest in at, and how has that changed over the last 2, 3 years? Because I mean, as everyone says, the valuations have come down, but one argument, or one particular number that keeps coming up is that they haven't changed much at seed or pre-seed. They have changed a lot in series A and beyond, but at earlier stages that hasn't been the case.
Yeah. Yeah, I don't think it's just a function of valuation. I think the other thing I think worth mentioning, what we shifted around, was like, what we call momentum based investing, meaning, again, if you go back to 2020, 2022, there was a large number, globally. I'm not singling out our region, but like but we know our region best, so we can talk about here. There are a lot of companies that we would label as momentum driven, meaning these were high GMV, high growth companies whose GMV was very high, their gross merchandise value was very high. The growth in GMV month to month, year to year, was extremely high. Were able to attract large amounts of capital to fuel that type of growth, but their value proposition was not super well defined, as reflected in their margins, basically, specifically their gross margins or their contribution margins. So I'll give you some examples. So one sector we stayed well clear of, even though there's, I think, a lot of debate internally whether we should do it or not, were these types of B2B marketplaces. So companies like Maxab, for example, Sari, Retailo, Bazaar, Shari. There was a ton of these, and I do think there's an opportunity there, and I think we at some point we may invest in something like that, but it has to be not driven by just we're able to kind of scale GMV super fast, but we're going to figure out how to expand margin later through ancillary services. I feel like that's always like an intellectually slightly dishonest way of approaching it, because it's very hard to tag on ancillary services that generate margin. It's intellectually possible, you can conceptualize it, but then actually in reality it's very hard to do that. So we ended up staying very clear of those types of businesses, because the value proposition was weak. It was really focused on just growth through subsidy, which we couldn't wrap our heads around it at all. I mean, Swivel was a good we were talking about Swivel before we started. There's an example of that in their B2C product, right? In their B2B product, which is the kind of solution for companies, I think that's a good product. That's there's use that has good margins, etc. But on the B2C side, you're not really solving a problem big enough where you can extract value through your unit economics and margin. So the only way to grow is through kind of subsidy, and the value proposition becomes a subsidy. And once you're subsidizing, you're just taking someone else's problem and making it your own without solving it. I think that's true of B2B marketplaces, true of kind of like, what happened with Swivel, and true of kind of many others. So we try to kind of identify the companies that look like that and steer clear of them. Um, and yeah, so that's kind of like a big segment of what we try to avoid.
In terms of the kind of companies that you want to perhaps stay away from, how has that changed over the last 2, 3 years? I mean, has it changed at all because of the slowdown in different sectors and venture overall?
Yeah, so I think that remains true. The sectors I mentioned, like, where it's easy to kind of beat up on these FMCG B2B marketplaces, but I think
Yeah.
what we're saying here is we're avoiding companies who cannot demonstrate their value proposition through their margin. If it's unclear that you cannot extract value from the market you're operating in, and you can only do that through subsidizing or taking someone else's problem and making it your own, we typically, we don't want to do that. we want to see companies that are solving for a real problem and extracting value from by solving that problem, and that is often reflected in the unit economics or the margin at some point. So you want to dig into that and understand how that works. So that's a big kind of sector that we try to avoid stuff that looks like that. um, I'm talking with the benefit of hindsight. So, but we're really very tempted to back some of these momentum plays before, but I think we feel a bit validated now, so we'll probably kind of continue to avoid that. And again, I think within this fund, the seed fund, it's really, always back great founders that you feel good about upfront. Um, and your instinct is almost always right around founders. Like 80% of the time, you're right. What you feel initially is what's right. And I think it's hard to articulate, hard to quantify, but I think, leaning into the instinct that we have as a team, I think matters a lot.
This is interesting that you mentioned these companies now, and you also mentioned that you are very interested in D2C and creating these local brands out of the Middle East that can go and tap this very large market opportunity. And you have some of those companies in your portfolio, as you shared, Iva being one of them, and then um, obviously HomeSmart is another. Um,
Yeah,
Now, when we look at D2C in the US, it the D2C sector overall, it hasn't done as well as many people
at
expected
all.
it to
No,
over
no,
maybe 3 4 5 years ago. And that is primarily to do with what you are saying out here about these enterprise these
exactly. Yeah,
B2B FMCG companies, because the margins just don't make sense at all. The unit economics are not there for them to be sustainable businesses. They were flooded with VC money and they were built their businesses with that, but they struggle to do well once it became difficult raising more money or they went to public market. So how is the D2C space in the Middle East different from the one in the US?
yeah. That's a great question. So I'll tell you, I think like the principal areas of difference are, as far as I can see in the US, as far as I can tell, the D2C space, and I think the stuff and I avoid that term because we're not really doing D2C per se. It's more brand bit like actual brand building. But we'll get to the nuance of the difference of that. But in the US, I think it was also like these momentum driven stuff. So if you have um, you produce cheaply, you grow your GMV, and then you ship primarily online. So it's omni-channel, but primarily online, but you make it very cheap to get to the customer. And then you're just arbitraging the price compared to other brands. I think the difference here in our region is that what we're looking for is um, building products that are speak to local tastes and preferences first, primarily. Every market, I mean, that's why they're not necessarily tech companies per se. So take Iowa, for example. Iowa, builds products based on what the market really likes at that price point. It's not about being an online provider, or having a D2C like an online channel. It's about focusing primarily on products that customers want, that tailor to their local idiosyncratic preferences in this region at the price points they're willing to pay. So once you go back to kind of first principles on that basis on building products, I think that's the kind of core difference in a market in the GCC specifically, where we don't make many things, right? We don't make many brands, right? There aren't, you name the sector in the consumer segment. We don't actually create many, clothing brands. We don't create many locally made, eyewear, furniture, even F&B. We don't create that many on a per capita basis, on a per capita spend basis, that many local brands. And that tells me that, every other market in the world, we lag behind on this metric. And the reason why you have like, global chains or global brands, but then you have a space for local brands, is there's always that kind of specifics of a local market that are not catered for by global brands that only a local provider can figure out. And that's the area we want to invest in. We don't want to invest in companies that just, sell online and sell very quickly at very low margins. That's not interesting to us, right? And that's, I think, D2C really. And I think the more successful ones in the US are the ones pivoting away from that, like Warby Parker is probably the closest to the stuff that we want to do. It's had its challenges, but that's closest in terms of the type of approach um, we have. So our criteria for this kind of D2C segment is building products that solve for local tastes at the right price point for for that consumer segment. That's kind of what we want to build for, and to create this kind of omni-channel experience where it's both online and offline.
I mean, I wouldn't want to take too much time speaking about these companies, but I had a few other questions. But moving on, you mentioned something while speaking about the kind of companies and you have been investing in from the seed fund and the geographies that you are looking at in terms of investments. And you mentioned SaaS from Turkey. Now, everyone knows about Insider, how big of a firm that they've been able to create coming in from Turkey and arguably using very little resources compared to, the same size of firm that would have been created in the US. And they've done fairly well, and it's a brilliant team. What is it in Turkish market or, the talent over there that, it continues to produce these software companies or gaming companies that have been able to build products for global markets and have done an excellent job at building big businesses out of them.
I think the first thing and most important thing is they have world-class um, engineering schools across the country. World-class, like, excellent, excellent sources of engineering and technical talent, whether in Istanbul, across the country. I'm not going to single out specific universities, but they have like really excellent kind of talent on that level. Secondly, I think historically it has been a very large local market, so it's one of the kind of largest economies in the world, and so um, the historically a lot of the world's uh, multinationals, blue chips would have entered that market beforehand, so they have a lot more exposure to working with on a global scale or with global talent. So you see a lot more of that. Thirdly, um, they're much more integrated with Western Europe, Eastern and Western Europe, the Balkans and Western Europe, economically, and so you have a lot of talent that has come and gone from Europe specifically. So they've kind of got a bit better exposure on the commercial side, but also like companies formed there have an aspiration to grow there, so to grow more globally. So you see that a lot. So that kind of experience, I think, is extremely valuable. And then lastly, their currency situation, the lira, is quite, chaotic and, quite inflationary, like it loses a lot of value. Um, that has led talent really for the past, you know, because this is not the past 7, 8 years, not been um, their first experience with this type of currency instability. They've been through it many times before. This has kind of built into kind of like the Turkish entrepreneurial ecosystem, generally, not just in tech, but generally, this need to kind of build for global markets, for not just for domestic consumption. And I think that ethos translates through in many, many sectors and is really well established in the tech sector. And I think that really helps. So a lot of companies built for global consumption from day one, right? For everything from like, dairy to textiles to gaming, like they're all looking global and they build that into their DNA day one. And coupled with the depth of talent that has more global exposure plus excellent engineering schools, I think that really helps. And then lastly, related to the lira issue is that the cost the cost of talent is not as high, so they're able to compete globally. So you combine all of those factors together, you have the good mixture of like the ability to build really software-driven businesses on a global scale. Starting with gaming, but into SaaS. I think it's very clear that that's the mixture that made it work.
Right. Speaking of currency volatility, the two markets that you have made some investments in, Egypt and Pakistan, that have seen, their currencies getting devalued by a very big number over the last 12 to 18 months. Does that play into your decision when you're looking at investing in companies in these markets, or uh, is that not
Yeah.
something important for a vehicle that you play?
No, no, absolutely. I think principally we look to invest in companies who have diversified sources of revenue outside of that geography. So if we're looking at Egypt or Pakistan, we're looking at companies that have demonstrable or already demonstrated um, revenue outside in either in dollar or dollarized terms. So we really look for that. That's one. And then secondly, there are some companies that can potentially like outrun it, but those are super rare or benefit from currency instability. Um, so we have one portfolio company in Egypt that is in the called Cylinder, which is in the used secondhand car,
Yeah,
secondhand car marketplace.
yeah,
And they actually, because the car automobile becomes like a stored value, so people use it as an inflation hedge, like real estate.
right.
So in dollar terms, that company is doing remarkably well. And the founder of that company, Omar Defrawi, has just been incredible at like navigating that space. So I think there are some opportunities like that, but they're very few and far between. The rule of thumb, the conventional wisdom for us is we're looking at companies that are building in local currency, so they get the kind of the price arbitrage of that, but then their markets are outside of their home countries.
When you started Nuwa in 2020, as you said, it was a different world back then. Things have completely changed over the last 3, 4 years. And you are now on your way to raising a late stage fund, as you said earlier, and you're also looking to partner with another asset manager on a debt fund. How has fundraising changed for fund managers like yourself over the last 2, 3 years? Now we keep hearing that there's a lot of money in Saudi, and that's one market you want to focus on if you want to go and raise from LPs over there. But generally speaking, what is the sentiment of the market at the moment for a fund manager like yourself?
I don't think it's easy. I think we're a bit more blessed in our region compared to other markets because there are, as you said, like more sources of capital locally, and our economies have been a little bit more insulated. I wouldn't say unscathed, but like a little bit more insulated. Um, but again, I mean, the same allocate. I mean, people forget that, in the Gulf and Saudi or whatever, the same allocators that are investing for us, they also, most of their exposure is global. So they took a hit in public markets, they took a hit in private in funds that they invested in abroad. So it's not so, I think sometimes they paint a rosier picture than it is. So I think it is also a little bit more challenging here. I think one thing that is really interesting to see is that the allocators have become much more sophisticated here, whether the family offices or the sovereigns in investing locally. They are much more metric driven, so they're really looking at like what you did in the past few years. We benefit by the fact that we're a bit early, but I think in a year or two, these allocators are going to start asking real tough questions about DPI, which is distribution to paid in, meaning, you know, you can mark at a certain value, but then did you realize that value? Did you, exit and give the proceeds back to the investors? So, I mean, not to go too much in the weeds, there's this big delta between TVPI, which is total value to paid in, and DPI, distribution to paid in. TVPI is basically what you mark the value of your portfolio. And so you say, I have company X, the last round was at, Y value, so I'm holding the value of my equity at this. And then distribution is what you actually sell it at. And and what you give back to the investors. I think there's a lot of what I expect is going to happen is that a lot of local managers are, because you get a little bit of latitude within a fund to mark TVPI at a certain level. Um, and I suspect a lot of it is just not honest. If I'm being if I'm being honest, I think I can see many managers, being slightly disingenuous with keeping the company at a certain value, knowing that it's way overvalued, but then another round hasn't happened, so I'm not gonna, mark it downwards. And I think the real pain will come when they come to exit these companies. And then when they come to exit these companies, the difference between the DPI and TVPI is going to be a reckoning, basically, like how did it was to change. Unless we go back to that high period we had a few years ago, then all is well. But I suspect that you'll end up in good companies where the TVPI is very different to the DPI. Your paper money value is very different to what you actually sell at. And I think a lot of allocators, investors in our region are aware of this and are thinking about it. And I think I worry about the industry overall when it comes to that, because if you have a bunch of distributions that are nowhere near the TVPI, I think it's going to cause a backlash, for us as fund managers. Um, so yeah, so I feel like there's a lot more sophistication. There's a lot more reticence to commit, so people are much more careful, much more kind of circumspect, thoughtful. Diligence is much better, and I think that's all good. I think that's all good for our industry, generally.
Right. And speaking of this, what are your thoughts on venture capital as an asset class over the last 10 years in the Middle East and North Africa? Has it lived up to the expectations? Because, I mean, some would argue that it hasn't generated the kind of returns that, were promised to LPs maybe in vintage year 12 or 13 or 11. Some of those funds should have been able to,
Yeah,
produce some very big
I think
exits.
those.
But yeah,
Yeah, I think net some of those early funds actually have done reasonably well. I can speak for the Wamda funds, done very, very well. Top, top, like I would say, global standards would be in the top performers. And some of our others, I think, some of the early Beko funds, I think, are really good. I can't speak for Becca because I don't know specifics, but I can,
right,
kind of
right.
guess which companies are in which portfolios. So you can say, oh, because this fund did well, better than that fund, etc. So, but I think reasonably the early regional funds did okay, um, did quite well. I think the ones that are later have, are the interesting ones. So you'll see some. I think you're going to see some great funds that came out of the 2017 to 2020 vintage. Funds there, I think, are really interesting because you have like interesting companies came out of that, the likes of Hala, the likes of Tabi, um, Sella. So companies that had those assets, I think, will start exiting in 2025, 2026. And those are really good assets and are really scalable, large assets. Tamara, etc. So Fresha. There's some great companies within that cohort that I think will drive the vintages of those companies. I think our vintage in Nuwa is later, so it's interesting to see what we'll do within that. But no, I think the asset class overall will do reasonably well. I think benchmark to global standards, but also benchmark to local public markets. If you benchmark us to the local public market, I think we'll do reasonably well. We'll outperform most likely or be in line with the benchmark. Um, that's my thought. But yeah, I think the asset class has done reasonably well. I think where the asset class people say, they didn't do well is when a lot of family offices, I think, invest directly and then they choose two or three assets and they get their fingers burnt. And I think that's where some negative noise around that happens. But then if you bought interesting exercise to do, maybe we can do it. If you if you bought the index of venture in different cohorts in MENA to time, what do they look like? And I don't think anyone's done that study. I think it like beats the definitely beats the local exchange. The index as a whole, I think probably does reasonably well. But I mean,
Right.
let's see. We have to run that. Yeah.
Right, right, right. And speaking of the companies that you think, I mean, the ones that you mentioned, Tabi, Pala, a few others that you think potentially could exit in 2025, what do you think their exits would look like? Because, we've seen,
I these are not these are not my portfolio
I know, I
companies.
know,
So
I
just
know,
I
I know,
don't
I
know
know.
if I don't know if they're gonna
No, no,
exit. Well, Tabi was a
no.
portfolio company from Wamda, but yeah, I don't
Yeah,
know if
yeah,
they're
but
gonna exit. But yeah,
what I'm
sorry,
trying
go
to
ahead.
understand is that we've seen different paths to exit of a company in the Middle East and North Africa. One is you sell to the leader, the global leader, which for a lot of companies in the Middle East has been Delivery Hero. They've made a lot of acquisitions in obviously F&B logistics in these spaces, and then we've seen two companies trying to go public through SPACs, which haven't done well. Both of them,
Yeah,
I'd argue. And then you've seen Jahez
who's that?
and
Anghami
Anghami
and
and
Swivel.
Swivel. Yeah. And then you
Yeah,
have Fawri and Jahez, which have gone public through local markets. And I'd say they've done reasonably well. I mean, obviously the public markets have changed, but they've done, especially Jahez has done remarkably well, considering that, it did not raise a lot of
yeah,
money as far as, the publicly available data shows. So,
yeah,
what do you think? How do you think the path would change in 2025? Do you see more global companies coming into these markets, coming into our markets, and acquiring the local market leaders, and them being them selling to
yeah.
these companies, or do you think more companies, for example, listing on Saudi Stock Exchange and some of these other stock exchanges in the region? How do you see that is going to take shape?
Yeah. I mean, just talking about, the companies you mentioned, I think on the SPACs, etc. So I think it's important to distinguish the difference between, I think, Anghami and Swivel. Whereas Anghami is
Yeah, yeah. Obviously, these
you
are
know,
two completely different companies. Please go ahead.
yeah, no, even their experience with listing. So, both, Anghami, relative to its list price, obviously has come down. I think its list price was 200 million, if I'm not mistaken. Its
Around
market cap
250,
now is
if I
around
remember
25 million.
correctly.
Uh, and now it's around 25 million. I think, but Anghami is really not a large business, right? Like it's a top line, I think of like 45 to 50 million in that range. So it's not a huge company and it's not with explosive growth, but it's a company. It's a real business that generates, I think it generates
Absolutely.
profit or close to it. And it has like hundreds of thousands of users and it's a real honest to God, business. It's just a question of was the value the right value and was the SPAC the way to go, etc. So I think for Anghami, it was a bad experience at the SPAC, but at least they're public company, and hopefully it'll keep going in the right direction, etc. Swivel, went public arguably it's not a real. It was never a real. The business didn't demonstrate its value proposition to that point I mentioned earlier around like actually solving a problem and then extracting value by that solution. So Swivel never got to that point. So its SPAC and the exit quote unquote was like totally unrelated to the size, profitability, value proposition of where the company was. So it's not the fault of the SPAC. It's the fault of like the company being there. It was just way too early for that. Like years. That's what I'm saying. So I'm cautious not to kind of overlearn that lesson from like what the lesson is from Alghami and Swivel, because I think it's not about that you can't exit. It's more that you have to have businesses that work, right? Like they have to have actual size, scale, profitability, value propositions clear, etc. And Jazz is a clear example of that. So, I mean, is it where that is a successful approach. So, I think if I was to look into a crystal ball and say what's going to come next in terms of exits, I would say definitely there's really interesting stuff happening on the Saudi exchanges. whether that's in the parallel exchange Numu or in the primary exchange Tadawul. And even in Abu Dhabi, I think there's a lot more liquidity. So if you look at like the level of depth of those markets compared to 5 years ago, it's a sea change, right? It's like a totally different world. Even the volumes are, on a different planet now, particularly on Tadawul. And projecting outwards, because so many firms have gone public, and I'm not talking about tech companies. I mean, like, your kind of traditional businesses have gone public at a rate, specifically in Saudi, that's, never been seen before, evolving and maturing that market. Uh, you're creating the environment necessary to have a much more robust IPO route. And I think that's happening. And I think the regulators are on top of it. The exchanges are really keen on it and are kind of hounding companies to list. Um, the companies want it. So we're going to see I think the IPO route really, really heat up over the coming 2-3 years. Obviously, overall market conditions are a big factor, right? Like, things, but it's a question of when, not if, because I think that Rubicon has already been crossed. So I think we're already well down that path. So I expect a lot more IPOs. I expect a lot more companies, in the same way Jahez has acquired a number of smaller businesses that are ancillary
Yeah.
to their own. I expect a lot of that to happen, whether in private companies or public companies. And the regional guys starting to be much more acquisitive. I expect that to happen. And the globals continuing to acquire. I think once the interest rate environment settles at a lower stage, I think you're going to see more and more people looking for growth elsewhere.
We've seen a lot of companies in the region struggle with governance issues, and some of them, have had to shut down their businesses in the
Yeah.
last 12 to 18 months. As somebody who invests in seed stage companies, when do you think the founders and investors should start looking at creating structures, governance structures for a company to be able to move forward? Because I mean, some would argue you don't want to do it too early because it distracts founders if you want to put a lot of efforts into those things. But what's the right time, and
Yeah.
where do you think we've made some mistakes as an ecosystem, and what have you learned from mistake? I mean, even if you've not made any.
Always make mistakes. Mistakes is
Around
part of the game. No,
governance.
on governance, on governance specifically, I, I want to kind of reframe it. So it's not about when do you do governance. I think there's always governance. There should always be kind of a governance is basically, I mean, just to deconstruct it, governance is basically the how you structure the relationship between a principal and an agent, right? Like, between capital and between the operator. So you have asymmetric information as the investor, and you're trusting someone to use your money in your best interests and in the best interest of the company. That's what it is at its most basic form. The shareholders agreement and having a 12-person board with 7 different types of veto. I think it's about holding the founders accountable to their behavior and asking the tough questions and making sure you know what's going on where it matters. And then the legal part of it, the contractual part of it, the structure, the mechanisms, that's just the way in which once you figure out what's going on is just how to formalize the relationship. But it's not about, I had this discussion with another investor recently where they were going a bit overboard with the shareholders agreement and the board because they were saying, oh, there's so much governance failures that have happened. And I'm like, yeah, you can put these 20,000 reserved matters inside there and they can't do anything till they have 12 signatures from all the investors. But if the founder is, rotten, if the founder wants to do something untoward, he'll do it if you're not paying attention to what's going on inside the business, not because he has to get 12 signatures from you. So if you notice, the point here being is you have to really be on top of what's happening, really understanding the financials, making sure that you understand what's going on, and then questioning discrepancies, challenging what doesn't look right, asking the tough questions, holding people accountable, creating kind of the ground rules. That's what matters more than what the mechanics are, if you see what I mean. The mechanics can help for sure, don't get me wrong, but that's not the essence of it. And so those questions are from day one, right? Those are not about having a board day one or not having a board if you're at seed stage. That's about you see something, you create the ground rules from which you want to ask what you want to know or the information you want to know. And then when you see something, that you ask the question, and you hold the founder accountable. And then later on, as it develops, you create more of the structure to make sure there's a better enforcement mechanism if something is not right, etc. So that's kind of my take on it. I don't know if it's super helpful, but I think it's less about the structure and the mechanics and more about as an investor being open, being eyes wide open, asking questions, not being worried about being a slightly confrontational. Um, the founder's not, they're your friends, but you have to be able to ask a tough question when something doesn't seem right.
Okay. Thank you so much, Khaled, for taking the time. It was a pleasure to have you here. I had a few more questions, but I think we've run out of time. So we'll probably do some of these other questions in a part two, hopefully in the next few days, whenever you launch the Go Stage Fund. Thank you once again for joining for this.
Awesome. All right. Thank you, Zubair. Always fun.